Welcome to episode 7, Along the Put Path. We're going to be discussing Judgment Day, the Black Swan event. This is a dark day. I feel like we should have Darth Vader music playing, the theme song, because this is what could kill the portfolio. So I want to make sure that I really dug into the details of what could hurt us. From a probabilistic standpoint, this system is a recurring winner. We win and win and win 85% of the time. And when you close out these trades at a 2x loss, the math is overwhelmingly in your favor. However, there's one thing that we can't plan for that goes outside of those boundaries and can cause us to have a max loss. Those max losses could effectively destroy and have you lose everything that you've gained throughout that year or more. So I want to make a couple of things clear. I'm not a professional options trader. I don't have my Series 7. I'm not a professional stock trader. I'm not an industry insider. I'm not a hedge fund manager. I'm just a guy with a day job who's just like you, started out as a beginner, learned and kept learning, read a lot of books, watched a lot of YouTube videos, reached out to industry experts like the Tasty Trade folks. I happen to have some friends and family members who are options traders and stock traders, and I'll get into some of those connections and history in other episodes. But I want you to be able to maximize your time, spend as little hours on research and technical analysis and trading as possible, and maximize your gains. So what we're doing here, putting a system in place that you can trade for as little as 15 minutes per week and get up to 50% returns. My returns have typically been over time 50%. I've been tracking all these trades since 2020. It's now 2025. And my consistent annual rate of return, judged by the capital that I have, my buying power reduction, is over 50% returns with this system. Some years it's a little bit less. Some years, like 2025, it's a lot more. But over time, I believe where I'm at right now is about 59% annual rate of return. That includes bull markets, that includes bear markets, it includes pullbacks, it includes corrections, it includes irrational exuberance, it includes COVID and the tremendous loss that we had during that period. So this system again is very effective. A lot of times the trades, it's an amazing Black-Scholes model. It takes into account the volatility, the deltas, the win probability, the pricing, the spacing that the stock can drop before you hit your strike price. It's amazing. As you get volatility that's going up, as stock prices go down, the amount of cushion that you have, the amount of safety margin goes up. In this system, if you do it precisely as I've laid out, is going to have you consistently profit on those weekly trades and you're going to make lots of money. So there's one scenario that's always in the back of my mind where we're going to lose a lot of money, and that could offset everything that we worked so hard for. That's called a black swan event. So what's a black swan event? In this context, in the stock market context, is where you have a crash that exceeds 6 standard deviations. So technically that's a 9.5% drop in one day. These are exceedingly rare events. From a probabilistic standpoint, Very, very rare. It's only happened 6 times in the history of the stock market. Stock market's been around since 1896. So roughly once every 21 years or so, we get these black swan events. It's interesting to note that they're unpredictable by nature, but they also seem to happen in clusters. We had 3 during the Great Depression back in the 20s. We had one on Black Monday, 1987, which everybody remembers is one of the darkest days, the darkest day in stock market history. And then we also had 2 during the pandemic of COVID-19 in 2020. So why am I telling you about this? Because these are the things that could kill the portfolio that we have open at the time if this event were to occur. The way that we teach it, we are monitoring our positions. We're closing those positions at a 2x loss in order to minimize losses. That provides us with that probability long term where we can beat the 85% probability of profit that's out there. However, if you don't close at the 2x percent or 2x 200% or 2x loss, if you don't close because you're not paying attention to the market, or you're on vacation, or you have a phone that died, or you have some kind of extraneous event in the stock market, like black swan event, we are all in big trouble. As the underlying goes down, you approach the hyperbolic downside of the normal curve, meaning as the stock goes down, you almost have a 1-to-1 loss because your probability of profit starts going to zero. You start to approach max loss. So for a standard trade that we have, for example, QQQ, you're going to make $50 credit, but you're risking $500 in buying power reduction. Max loss is $450 because you would have the $50 credit from when you open the trade. And then when you close the trade at max loss, you would have a $500 loss. It's going to net you a $450 loss. Now, the way that we do it normally, we would close out of that trade at a 2x loss, which would be we would buy it back for $150, which would net us a $100 loss. However, if we have this kind of black swan event, you could possibly lose all of that capital. You could lose that $450. So, at the time I wrote this blog post, I think I had about $72,000 that was currently in play for buying power reduction in options. So theoretically, I could lose $72,000 in one day. That should open up your eyes. That is a very sobering thought. Nobody wants to lose that kind of money in one day. However, what I've noticed is over the last 5 years, I have never had a max loss trade. So we're talking over 1,000 trades. We're talking over a 5-year time period. We're talking through a pandemic. And there's been some other times, 2022, 2024, where we had some pretty sharp losses in the stock market, some pretty quick drawdowns. 2025, we had very quick drawdown when we had the tariff issues. And in all of those issues, over the last 5 years, I've never had the max loss. I've been able to try to trade out at the 2x loss, and I've never had a max loss. However, I would be remiss if I did not explain this risk to you. So, another good thing about our system is we have 12 different underlyings. Only 7 of those are stock based. So, that provides diversification, and that's gonna help us with mitigating those losses. So, the real worst case scenario is that we have an overnight loss, black swan loss, where the stock market opens the next morning and we cannot trade out of it. That is truly cataclysmic and that would be disastrous. What we can only hope is the next time we have a black swan type of event is that it occurs throughout the day. So you can see it coming so that you're able to hit your 2x loss and trade out during the middle of the day. Another alternative would be a lot of times in the stock market, you have an indicator a day, a two, a week before where you have a sharp loss. Let's say you have a 2%, 3% loss. And then the next day might be the 9% or the 6% or the 5% loss. So you have a leading indicator. So hopefully those leading indicators are going to allow us to trade out at the 2x loss so that we don't hit our max loss later. So let me also revisit this point. 7 of the 12 are stock based, right? The 13th one that I also add in is the VIX. So really, only 7 of the 13 are stock based. And the VIX works in your favor because if we had a black swan event, you're going to win on that VIX trade because it is a negative correlation to the stock market. So let's look at the other 5. So when we have alternative assets, Bitcoin, gold, oil, real estate, and bonds, many times, particularly with bonds, when the stock market's going down, those 5 asset classes will be going up. So again, that offers protection, and hopefully we'll be able to win on the 5, even if we lose on the 7, if there was some sort of broad stock market reduction. So that's it. Wanted to make sure that you understood the risks of this system. The risk is out there. However, it is exceedingly rare. And again, we haven't seen it yet in the 5 years that we've been doing this, but it is possible, and it should be in every trader's mind that you need to be vigilant, you need to be ready, you need to be aware, and you need to be monitoring your positions. And if you can't monitor your positions because you're on vacation in a foreign country, let's say, close them. Close them all before you leave. You don't want to get caught where you cannot close out of those trades. Hopefully this helps. I look forward to talking to you more as we go down the put path in episode 8.